Hi, my name is Morris Franco. This is the third in the series of videos I'm doing on the national debt crisis. In my first video, I mentioned some of the things I cover in my book, The National Debt Crisis, America's Armageddon, that the Federal Reserve was pulling a massive con game on the American public. I will now explain what I meant by that. In my opinion, this is the biggest con game in the history of humanity. The U.S. government borrows $17 trillion by selling government securities to investors and then buys back its own securities in the open market. This is the equivalent of having a shill at the auction. The Federal Reserve is in fact manipulating the bond market. In America, manipulating the price of any product available to the public is illegal. That is illegal for everyone except the Federal Reserve. This is a joke. I can't think of a single product on planet Earth that has a market value higher than the U.S. national debt. Yet the government entity responsible for ensuring the economic wellness of the nation is permitted to peddle trillions of dollars worth of bonds at a price different from its true market value. The purpose of the Fed's action was to force down interest rates and accommodate the economy by buying bonds en masse. Buying bonds puts upward pressure on the price of the bond and simultaneously puts downward pressure on the bond's yield or interest rate. For example, if you buy a bond with a 3% interest rate and pay par or 100% of its face value, you will receive $3 in interest annually for every $100 investment, or a 3% yield. Let's say the Fed buys enough of the same bond to push the price up to 150% of its face value. The purchaser will receive the same $3 on a bond that now costs $150, or a 2% yield. This equates to the Federal Reserve lowering the interest rate from 3% to 2% because the Fed can now issue new $100 bonds at a 2% rate. Here we are, a country founded on free market principles, and we allow the Federal Reserve to bully the bond market and force investors worldwide who invest in U.S. Treasuries to accept a security with a manufactured interest rate. As mentioned elsewhere in this book, a mere hint from the Federal Reserve that I was going to slowly reduce the monthly bond buying program that supported low interest rates rocked the bond market and sent rates up 50% in 1 week. In my opinion, the spike in rates reflects the skepticism bond investors feel about the true market value of these government securities. It is likely they believe that without the support of the massive bond buying program by the Federal Reserve, the bonds would carry a substantially higher interest rate and lower market value. Investors who own long-term government securities will likely suffer substantial losses with the return to normal interest rates. The longer the maturity of the bond, the more severe the potential loss. There are a lot safer investments than lending the U.S. government billions of dollars for 30 years at 4% or 10 years at 3%. The lengths the Federal Reserve is willing to go to push down interest rates is astonishing. Since the start of the quantitative easing program in November 2008 through January 2014, the Fed purchased over $4 trillion in securities. That's more than all the tax revenues collected by the United States in 2013 from individuals and corporations, which was $2.8 trillion. Those who support this policy would argue that the Fed is doing exactly what it should be doing, and that is executing monetary policy that will help stimulate a staggering economy. Of course, this is true. With a $17 trillion national debt and budget deficits averaging $1 trillion a year for the last 6 years, it is any wonder that the credit rating of the United States is going down the toilet and that our economy is not up to par. The Federal Reserve's $4 trillion in bond buying purchases over the last 4 years is a stark admission that interest rates on treasuries would be substantially higher if we're allowed to trade freely in the open market. If this were not true, there would be no need for Fed intervention. It is extremely important that concerned Americans understand that all markets function purely on perception. That is, a stock or bond is worth X because it meets a certain set of parameters unique to each investor. There are a zillion financial analysts out there that will provide you with charts and graphs that show what a stock or bond should sell out based on their own set of parameters. In my opinion, these analyses have very little value. Market sentiment or perception trumps any chart or graph. Simply stated, it is presumed all stocks or bonds trade at fair value because the buyer and seller exchange cash for securities at a mutual agreed upon price. When you purchase a security, the seller is not doing you a favor. He's happy to get rid of security at the price you're willing to pay for it, because he believes his money could be better used elsewhere. When you sell a security, he's willing to take the security off your hands because he believes he's wisely investing in the stock you are selling. Market perception can change dramatically, as evidenced by the dot-com bust from 1999 to 2001, when a household name like Amazon.com dropped from $107 a share to $8 a share, and a bellwether like Cisco Systems lost more than 80% of its value. As a matter of fact, the slide in the tech-heavy NASDAQ was so severe that the average loss for all listed stocks exceeded 80%. From March 2000 through October 2002, the NASDAQ Composite dropped from about 5,000 to 1,000. This is a stark illustration of how market perception can change in a relatively short period of time and have devastating consequences. Amazon and Cisco Systems continued to prosper as companies, but investors suddenly took the herd mentality and rushed for the exit. At its high and at its low, the NASDAQ listed securities traded at their fair market value, unencumbered by any outside influences. This is not the case with U.S. government securities because of the hanky-panky on a part of the Federal Reserve resulting from their quantitative easing program. In my opinion, continuing massive purchases of government securities is creating a pressure bubble by forcibly keeping prices up and interest rates down. The pressure is steadily building because of the growing national debt, continued deficit spending, and the declining creditworthiness of the United States. When the Fed opens the pressure valve, whether forcibly or voluntarily, interest rates will probably rise sharply and start a series of events with severe negative economic and social consequences. For lack of a better term, I call it the possible bursting of the interest rate bubble. As of January 2014, investors in government securities owned about $1.5 trillion in Treasury bonds yielding less than 4%, and almost $8 trillion in Treasury notes yielding from 1 to 3%. In my opinion, the primary reason investors are willing to accept these low rates is they take comfort from the Federal Reserve's bond buying program, which ensures sustained low rates and protects their market value. In any case, Treasury securities are a liquid asset, and investors can liquidate their positions at will. I believe that rates will rise substantially once the Fed ends its bond buying program and moves away from its aggressive low-rate policy. As with the dot-com bust, putting a value on any asset is a mindset, and when investors wake up to the fact that the financial condition of the United States is in tatters, higher rates are almost a certainty. It doesn't take a PhD in economics to identify this problem. All the data needed to support this issue are in the public domain. Nor does it take a PhD in economics to bring this issue to the forefront. All that takes is a competent and unbiased media. However, it will surely take a PhD in economics to resolve the economic issues our country faces right now, much less on the crisis scenario that will feature trillion-dollar debt interest payments, higher interest rates, and the ballooning national debt. There is no doubt in my mind that the President and Congress come up a little short in the area of economics. Thank you for listening.